This notebook right here, I have the one stock I'm buying over Nvidia right now. But before we do that, first of all, we have to talk about the incredible earnings from Nvidia. They blew everybody out of the water, literally video game level earnings, and not in that sense.
Revenue doubled year on year to 13.5 billion US dollars, higher than Nvidia's own forecast and the market as well. EPS $2.70 a share. 429% year-on-year rise, Frank. And there are no signs of slowing. The company forecasting for the September quarter revenue of $16 billion, blowing away estimates and representing, if met, an 170% year-on-year rise.
We're going to review the numbers today. We're going to go over the business model and where Nvidia is headed and their very bright future. And I'm going to explain to you why I'm not investing in Nvidia right now, despite the greatness of this company. And I'm really a fan of what they're doing. But at the end of the video, I'll actually reveal to you which company I am investing right now for AI exposure and Nvidia exposure at a much better price with much more upside. And no, it's not AMD. So relax over there, the AMD fanboys. Before we get started, I have to give a huge thanks to today's sponsor, Tendies. Tendies are working with me for over a year. They provide a free newsletter for you to get the best information on the internet about the stock market, economy, geopolitics. They have a free options flow and options calculator. You can link your own brokerage to their website and get personalized information. They offer some of the best info and data I've seen, and they're absolutely free. There's no premiums, there's no upsells. Tell them Tom sent you. The link to join is below, and thank me later once you join, because look, at the end of the day, good information is the key to success in this market, and Tendies provide that for free. So why not? Give it a go. Let's go back to the video. So Nvidia just beat earnings. They beat revenue, they beat EPS, and they guided for $16 billion of revenue in the next quarter with 250% increase in revenue from data centers. Now we're going to talk about data centers in a minute because that's a story in its own. But they also announced $25 billion of a buyback. And at this point, I think it's pretty safe to assume that Jason Hank is definitely up there with the top 3 CEOs in the market right now, along with Elon Musk and probably Anthony Noto. I know I'm going to get a lot of hate for this, but, shout out to Anthony Noto. You in that list for me. You're my top 3 CEO. At the end of the day, you have to look at CEOs with what they're working with, what their roster they have, and how much championships they win. Jason Hank is, he has a top tier team. Elon Musk, he has a top-tier team. Anthony Noto, he took SoFi when it was hot trash, and look what it's making it into. So, Anthony Noto, you're on my list. Now, let's move on. And by the way, if you want to come on for an interview, I'd love to have you. Now, look, let's dive a little bit deeper into the Nvidia numbers, and then after that, I'm going to reveal to you which stock I'm actually buying. Because I do want to show you how great the Nvidia numbers are, but also where the chinks in the armor can be if you actually look a little bit deeper, where the risks are and where the problems are. Now, Nvidia numbers are some of the best we've seen recently. Revenue is up 101% year over year, with obviously data centers leading the charge. I'll talk about that in a second. We're going to do a deep dive into every single KPI of Nvidia. The guidance out of this world, they're guiding for $16 billion for the next quarter. That's absolutely insane because the estimates, we're talking about $12.5 billion. That's a 30% increase in the guidance quarter over quarter and a 20% increase from the already insane 13.5 they did this quarter. So the insanity of this is, I can't put it better than Dan Ives, a friend of the channel. And by the way, I had an interview with him here in the channel. Go check it out. Dan Ives said it the best. Jaw-dropping demand. So when we're talking about this jaw-dropping demand, let's break it down, because when you do break down these things into the KPIs, your head literally flies off how good this thing is. Look, data center revenue went from $2 billion in 2021 to $10.3 billion. From Q1 2021 to Q2 2023, 2 years, up from $2 billion to $10.3 billion. That's a 400% increase in 2 years. Now, don't go 2 years back, just go 1 quarter back. Quarter over quarter, they went from $4 billion to $10 billion. That's a 140% increase in revenues from data centers quarter over quarter. So this jaw-dropping demand is definitely in the data center section, not in the other stuff. But hey, the other stuff they do, they actually are doing pretty well. Look, the gaming sector actually suffered a little bit of a decline recently, but it's bouncing back up. It was $2.8 billion in Q1 of 2021, and it dropped all the way to $2 billion in Q2 of 2022. Now it's bouncing back to $2.5 billion. So it's trending up. It is down from the peak by 11%, but it's up year over year by 25%. So gaming is recovering. It's not going to be as huge as data centers, but it is a major, major impact on their financials. Now, the professional visualization, I can't say professional visualization, I can't say it. Now, on the professional visualization side, absolutely insane. Q1 2021, 370 million. Now, here's the crazy part. If you look at this number and you compare it to Q2 2023, they've only done 379 million. So it's flat if you compare it to Q2 2021. But again, there was a major drop. They dropped massively to 200 million in Q3 2022, just 9 months ago. And now they're bounced back to 379, so the peak level. They're up 90% on this sector within 3 quarters. Absolutely insane. So all the trends are actually going up for Nvidia, not just data centers. Now, a lot of people talk about the automotive side as their big next, S-curve, explosion, implosion. I don't know. Look, at the end of the day, it's still a minuscule amount of their business. We're talking about 150 million out of, 13 billion in revenues. So let's just pump the brakes on the automotive side. But the growth rate is actually impressive. I'm not going to take this away from them. They deserve their flowers. In Q1 2021, they had $154 million in revenues from automotive. In Q2 2023, just 2 years later, they're 253. So we're talking about 64% growth in 2 years. It's not as crazy as the data centers, but it is growing. So you can't ignore this. But it's still a tiny portion of the entire business. Right now, if you're buying Nvidia, you're buying it for the data center business. Everything else is just adjacent to this. And as far as this increased jaw-dropping demand for the data center business, where is it actually coming from? Well, look, the entire server world as we know it is basically changing. We're going from CPUs to GPUs because of all this AI requirements. Now, whether you're upgrading or building new ones, you will have massive capital expenditures changing your infrastructure to fit AI. And that's where Nvidia comes in because they have pretty much number one position in the market and the demand shows this. Nobody comes close. But the problems here, and we have to actually talk about the issues here, is that it's not an infinite project. Unlike Palantir, for example, and I'm sorry to bring Palantir back into the fray because you didn't click this video to hear me talk about Palantir, but Palantir has pretty much an infinite demand. As long as they provide these services, the companies, at least in theory, might need them forever. With this project, with the data center upgrade project or new builds, we're talking about a massive total addressable market of about $1.5 trillion. It's a lot of money. It's a lot of revenues, but it's a finite project. Whether it takes 2, 3, 4 years, at the end of the day, it's going to run out. It's going to dry out. And that's something that you have to take into consideration. This isn't a start of a new 10-year cycle where these demands basically come back every year. The other problem is that there's going to be a lot of competition. Where so much meat in the bone, so much money in the market, competition has to follow, whether it's internal or external. A lot of their clients probably going to start building their own because at these prices, why not try? And of course, there's macro issues. The economy can go to the toilet or a new war can break out, geopolitical stuff. And that obviously will hurt Nvidia because the demand for data centers is not going to go as crazy if the economy is in the toilet. You would agree with me here. But still, Nvidia is a terrific company with a bright future. And the question here might be for you is, if that's the case, why am I not buying? Why I'm about to talk about a whole different company in about a minute. Well, number one, they are a terrific company. But the reason I'm not investing at this juncture is very, very simple. They're currently trading at $509 per share. That's implying an 85% growth every single year for the next 5 years. I ran my DCF. I reverse engineered this. I use a 12% discount rate. I'm getting 85% growth. Now, look, they might get it. They might not. It depends on how long this bull cycle continues with the upgrades of the data centers. Now, to me, they're priced right now as if that 85% growth is a lock. I don't know. That might take 2 or 3 years for the demand to dry out. I don't know. There's also obviously risk I mentioned, geopolitical, macro risks. At this point, Nvidia is priced for total perfection for the next 5 years. And I think there's other undervalued plays out there for you to invest in. And myself, of course, this is not financial advice. Do your research, make your own decisions. But I think for me, there's better opportunities out there that are a little bit more undervalued and misunderstood. Palantir being one. But again, this video is not about Palantir. But there's another. Let's talk about it right here. So I want to talk about a stock that's called Super Microcomputer, SMCI. Now, this company is currently trading at $277 per share. They are up 180% over the past 6 months. Yes, I just said it. They are up 180% over the past 6 months, but they're still hella cheap. Hear me out before you laugh and make a decision. I'm not just saying this. I'll get to the numbers in a second. Now, this company has massive NVIDIA exposure because what they do is they build servers. And they build servers with NVIDIA components. So whatever it is NVIDIA is doing, whatever that demand on the NVIDIA side, it's going to flow over to this company. Supermarket Computer is going to actually build the servers. They have absolutely insanely good products. Companies love them. They have a terrific relationship with NVIDIA. And they're pretty much the first to the market with all the newest innovations coming out of NVIDIA because of their insanely good relationship with the company. Now, look, at the end of the day, let's look at the numbers. I'm going to show you right now. Even though they went up 180% over the past 6 months because of this NVIDIA relationship and that NVIDIA correlation, which is there, make no mistake about it, they're still trading at 23 price to earnings. 23 PE, my guy. 23 PE, not 230 like NVIDIA, 23 PE. They're only a $15 billion cap company. I know I just said only, but compared to NVIDIA, $15 billion doesn't seem as much. They're trading at twice price to sales, 2 price to sales. Yes, I just said it, 2x price to sales. They have twice the assets than liabilities. They have more cash than debt, 450 million of cash, 290 of debt. They have a 9% net profit margin, and that's a hardware company. Their revenue grew 37% of the past year and 113% of the past 3 years. They have 80% of institutional shareholding. Their EBITDA grew 122% of the past year and 700% of the past 3 years. And look at the efficiency. Their operating expenses, while they just increased revenues by 37%, only went up by 12%. Now, they're also not CapEx heavy, which is the part that blew my mind because at this point, I'm expecting to see a lot of capital expenditures. This is a hardware company. There's massive CapEx. Their CapEx is currently $30 million per year. $30 million per year for a company that generates $7 billion in revenues. Look, Nvidia just gave you $13 billion in revenues and they're growing like crazy. This company is generating $7 billion. They're extremely efficient. They're built like a tank, great margins, great cash flow. And they're trading at this PE, 23 PE, twice sales, with all this relationship and correlation with NVIDIA. Absolutely insane. Now, I actually ran a DCF on this company, and I assumed only 30% growth. No, nothing spectacular. 30% growth at 12% discount rate. I got a $450 per share price target on a 30% growth. Imagine if NVIDIA isn't bullshitting and NVIDIA is actually going to fly up. What do you think is going to happen to this company? You don't think their demand is going to go up like crazy? Because they're actually building the servers that NVIDIA is building components for. So these guys are going to fly up. Yes, they're hyped, but look at how cheap they're still trading. It doesn't have to be a mutually exclusive arrangement. But look, if you want to invest in this company, you have to understand something very important. It is a hyped up company. SMCI is a hyped up company. No company goes 180% in 6 months and is not a hyped up company. It is. But there is a way to invest in hyped up companies without overpaying. I literally made a video called How to Invest in Hyped Up Companies Without Overpaying, showing you the entire system, warning you from the pitfalls, showing you how to do it. I'm going to put it on the screen right now, on the end screen. Go check it out right now. And if you haven't yet, make sure you subscribe to this channel. And if you haven't yet, go to our Patreon, check it out, and join our academy. There's final spots left before we go from $35 to $100 per month. Learn how to do your DCF. Learn how to become a better company evaluator. Join the academy. Try it out for 30 days for risk-free, money-back guaranteed. I'll see you in the next video.